Index fund. An index fund is a low-cost investment vehicle designed to mirror the performance of a specific market index like the S&P 500. It uses a passive strategy, meaning it simply follows the index rather than trying to beat it through active stock selection. The fund can achieve this through full replication, buying every security at its exact weight, or through sampling for broader indexes, which buys a representative subset of stocks. The goal is to deliver the index's return minus minimal fees, typically ranging from 0.03% to 0.1%. Index funds achieve their cost advantage through a simple, automated strategy. The typical expense ratio is a tiny fraction of a percent compared to over 1% for many actively managed funds. To see the impact, consider two investors, Alice in an index fund and Bob in an active fund, on a $10,000 investment over 10 years. The fee difference alone costs Bob about $2,600, and that's before considering any potential difference in returns. Index funds offer a powerful advantage for long-term investors. Decades of research show that most active fund managers fail to beat their benchmark after fees over 10 years or more. By buying the index, you capture the market's average return with lower costs and less risk, while also gaining a core position that traders routinely use for hedging. To use index funds effectively, start by picking the right index like the S&P 500 for US large caps or MSCI EAFE for international exposure. Look for a fund with near-zero tracking error so its return stays close to the index, and always reinvest dividends automatically to let compounding work. Finally, hold your shares for the long term, because frequent trading triggers taxes and slows down growth. Even with a simple index fund strategy, it's easy to trip up. A common mistake is buying overlapping funds, like owning an S&P 500 fund alongside a total US stock fund. They often hold the same companies. Also, watch out for expense ratios in funds that look like index funds. A 0.4% fee might sound small, but cheaper options at 0.2% exist. And don't try timing the market by jumping in and out, because that's a recipe for lower returns. Finally, remember that index funds come in two forms. ETFs trade throughout the day and are tax efficient, while mutual funds only trade at the end of the day.